Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Hey, and welcome to another edition of Your Money, Your Wealth. My name is Joe Anderson, certified financial planner and president of Pure Financial Advisors. Of course, I'm always with the big man, Big Al Clopine. He's a CPA sitting right over there. Got a great show lined up. It's end of year. There's still a lot of things that you can do in regards to your taxes. But let me ask you a couple of questions. I ask a lot of people, are you charitably inclined? A lot of you say yes. There's a lot of organizations that I love to support. Others of you say, you know what, no, I'm more family inclined. I want to make sure that I pass most of the wealth to the kids. Well, let me tell you something. Everyone that is watching this television program right now is charitably inclined. If you're not giving to an organization, who are you giving the money to? You got it, the IRS. I want to talk about some strategies today that if you do things correctly, you can save a ton of money in taxes before it's too late, because you got until December 31st to do this. But if you look at some charitable giving strategies, you could give to a charity and less to IRS. That's what's on my mind today. So here's the deal. When you take a look at the IRS code, it's 100 years old. What did they do prior to the IRS taxing us? That's right, there was a lot of people giving to charity. But then, you know what? So many people said, you know what, I don't want to give to charity, I just want to keep it to myself. And then the IRS said, or the United States government said, hey, we need some capital, so the tax system came involved. But now, here's the deal. The IRS still does this. If you plan a gift, they will forgive a tax. It's a big deal. So would you rather give your money to the IRS, or would you rather give it to an organization? That's what this show is all about today. To help me sort through this stuff, let's bring on the big man, Big Al Clopine. Hey, when it comes to tax planning, charitable giving is still probably one of the best things that people can do. And there's still time, because we still got some time left before the end of the year, Big Al.
Well, there's no question. And that's actually why we're doing this show this week, because there really is still time to get your charitable deductions in. And for every dollar that you give to charity, you'll receive a tax deduction. So our show is going to focus on the absolute best strategies to be able to consider between now and year end. And I think a lot of us, when we think about charity, as Joe just said, it's like, well, maybe I'm not that charitably inclined, but if you're not, you are giving more to the IRS. So in this show, we're going to talk about why we want to give to charity. And the second thing we're going to talk about is the different ways to do it. And then most importantly is how to create tax deductions. I think that's what we're all interested in. And Joe,
well, is it really? I mean, I think some people really want to give to charity.
Well, I'm going to say this, Joe. In my 30 plus years in business, I've never had a person say, you know, I'd like to give more in taxes. Everyone wants to give less.
True, but I think there's more people that said, I would like to give more to charity.
Yes, quite a few.
And so we can talk about some different ideas and some strategies on exactly how to do that, because tis the season. Happy holidays, everyone.
That's right. Yeah, absolutely.
Go ahead.
Anyway, I think let's get started, Joe. Let's get right into this. So why do we give? Giving may improve your sense of well-being. Is that true for you, Joe?
That is very true for me.
You feel better when you give?
Absolutely.
I do too.
Every single day.
How about volunteering? Volunteering your time may result in physical and social benefits.
Yeah.
Now I know you volunteer what? Meals on Wheels? And
yeah.
so forth?
Yes, I do volunteer. I don't have a lot of time. So we do the TV show, we got a radio show. I'm a president of one of the largest fee-only financial planning firms. So when I do find time, I really enjoy it.
Yes, yeah. And for my own part, I volunteered. I actually have coached baseball and soccer for 10 years when my kids were younger, and that was actually very gratifying. But in a lot of cases, we give, not only because we feel better, but we also get a tax deduction. And that's really what we're going to focus on today, is how to create the biggest and best tax deductions. Now, when you look at how to go about this, there's different ways to give. I mean, obviously, you can give cash, you can give by a check, you can volunteer your time, you can give appreciated stock or even appreciated real estate if you want to. And I want to hop right into giving checks or cash, because this is what most of us do. And when you think about it, first of all, checks are going to be better. Why? Because you have proof. You have proof that you actually made that donation. And something to consider is if you give more than $250 to any organization, they must send you a letter acknowledgement that you actually gave that donation, because if they don't, it's not deductible upon audit. So be aware of that.
What is, you know, you take a look, if I'm giving to an organization, so $250, they have to, how long does that take? Because you got until December 31st. I mean, does people have to hunt people down to figure out, hey, I gave to you, make sure that I get a receipt for that?
Yeah, well, typically, Joe, the institution has to give you a letter by the time by the next year, by the time you file. I think maybe it's even January 31st, but it's with your canceled check and with the with that letter acknowledgement from charity. That's when you can actually take that deduction.
Well, let's talk about the deduction for a second here. So if I'm going to give to charity, how does it work? So if I give $250, I mean, how much does that really save me in taxes? Or if I give $10,000, $50,000, $100,000, how does all this work when you really take a look at the tax savings that you would receive?
Yeah, that's a good question, because really with taxes, with charitable donations, I should say, it's a deduction, it's not a credit. So that means if you make $100,000, for example, and let's just say you give $10,000 to charity. So now your taxable income, after all deductions, let's just say it's $90,000. I'll just say your taxable income would have been $100,000, now it's $90,000. So you save $10,000, and it depends upon your tax bracket. So let's say you're in the 25% tax bracket federal, that's $2,500. Maybe you're in the almost 10% bracket, you know, as far as state. So that would be then another $1,000 or so. So maybe about $3,500 savings from doing this charitable donation.
You know, some people have to be careful because there's a lot of scams, especially at this time of year. People are looking to give a little money away to try to make a difference in someone's lives. And there's so many different charitable scams. So we have a couple of different warnings out there to make sure that you understand, are you going to a legitimate charity? If someone's calling you on the phone, you know, just take a look at a couple of different things here.
Yeah, and this is right from the IRS. They're talking about, well, make sure you donate to qualified charities. Well, how do you know if they're qualified? Well, we're going to show you here in just a moment. Don't give out any personal information. Don't send cash. And if there's any suspected fraud, make sure that you report that. But really, as far as knowing whether you have a bona fide charity, you can actually go to the IRS website, and it will tell you on that website, you go to irs.gov, and I found the easiest and best way to do it is there's a search box, and just type in exempt organization search, and then you can type in the next frame your charity and make sure it's a legitimate charity. But this happens a lot, Joe. You know, when there's natural disasters or people are wanting to give, the fraudsters come out and they start making up charities, and they call you and they put pressure on you, and you think you're giving to a good organization and you're not.
Yeah, I mean, it happens with everything. It's crazy nowadays of how many different scam artists are out there. So even though it might sound really good on the surface, just do your due diligence. Double check this, because, and like Al said, do not give cash. Do not give your personal information out, because if you look at identity theft and everything else, be very, very careful. You know, it's awful that you're trying to do something very, very good and then someone's taking advantage of that. So just be careful. Now, hey, when we get back from the break, what I want to do is I want to get into some strategies and some ideas that we have that can significantly reduce your tax bill this year. If you have highly appreciated stock, if you have highly appreciated real estate, and you don't want to sell it because of the tax bite, there's some moves that you can make. So stick around and I'll tell you exactly how to do it. You're watching Your Money and It's Your Wealth.
Hi, I'm Matt Balderston, Certified Financial Planner with Pure Financial Advisors. Did you know Americans 55 and older now account for about 20% of bankruptcies, mostly caused by medical and funeral expenses?
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. That's Big Al Clopine. Thanks for tuning in. Talking planned giving, figuring out ways to reduce your taxes before it's too late. Alan, did you know that you can't bring one pair of underwear to
Paris?
To Paris?
We just learned that from our cameraman.
You can't do it. You cannot bring one pair of underwear to Paris.
That's what we just heard. I think it was in reference to a second monitor that we needed.
Yes, so yes.
Anyway, we're good.
If you're going to go to Paris, make sure that you bring more than one
That's
pair.
the main thing.
That is
If
the
you
main
learn anything
thing.
today, that's the thing.
That is the main thing. All right, hey, if you're thinking about saving money on taxes, this is our favorite time of year because Big Al and I do a tax planning course. If you want to go, take a look.
Get out of the tax trap. Join Pure Financial's Joe Anderson and Al Colpine December 3rd for a free end-of-the-year tax planning seminar. Minimize your taxes on your IRA and 401k. Grow your retirement income tax-free. Create tax deductions when the market goes down. And much, much more. Register today by calling 855-99-TAXES. That's 855-99-TAXES.
Yeah, well, definitely love to see you there. It's a couple of hours of fun, but more importantly, it's a lot of information to help you figure out what you need to do in this crazy world that we live in regards to your taxes. Let's talk in more things about the true-false question that we just played.
Okay, good. Let's see. If I give away old clothes and appliances to charity, I can deduct the current value of those items on my tax return.
You know, I want to know about this because let's say that I have some old suits. I know you and I talked about this before. So let's say I have old suits and everything else. Maybe I paid $500 for the suit. So if I give it to Goodwill, I can write that off on my tax return. But how much can I write off?
Yeah, not $500. It's actually for whatever the current value is. And Goodwill and Salvation Army actually do a pretty good job of giving you a list of those. So if you want to get them, usually, I mean, if you don't know, usually I would take around a 20% of cost or maybe something a little bit lower. That'll at least give you an idea. But yes, giving your clothes, giving your old appliances, giving tools, whatever to charity, you will get a tax deduction. Joe, you give away your old clothes to charity?
Yes, I do.
You wash them first?
Well, they're suits, so, you know.
You dry clean them?
Yes, I dry clean them first
just
and then I give them away. Well, do you think, well, your suits, you probably get a premium because Big Al wore them.
It's possible.
Yeah, whatever. Okay, hey, let's talk about if you want to sell highly appreciated stock, what are some of the things that you need to do? Or if you're looking to give to charity, what type of mechanisms that you want to look at?
Yeah, let's go over this example because a lot of people are not doing this. If you have stock outside of retirement and it's appreciated, here's an example. It's worth $10,000 today and the original cost is a couple $1,000, you get a tax deduction of $10,000. So, and plus, you don't have to pay taxes on the gain. It's the same for real estate. Now, you're not necessarily going to give your entire piece of real estate, but we're going to go over a strategy that you may actually want to do that. But realize this, if you're giving away cash or check, it's just a straight donation. But if you're giving away appreciated stock, you get the value of that stock as a donation deduction, and you do not have to pay tax on the gain. So it's pretty cool.
Here's another strategy that you might want to take a look at. So let's say that you have highly appreciated stock, and so you want to give more than $10,000, or maybe that you have a piece of property. Now, this is very common. What we see quite a bit is, let's say that you purchased in a single-family resident, maybe it's a tenant in common apartment building, whatever the case may be. You bought it a long time ago, maybe for $100,000. Now it's appreciated maybe to $1 million. We see this quite a bit in San Diego. So let's just take a look at a building here that is now worth $1 million, okay? But you bought it down here for $100,000, and then when you rent out a property, there's something that's called depreciation, and so what happens is that your basis reduces even further. So the problem is that, all right, well here, I don't want to be a landlord anymore. I want to get rid of the rents. I would like to have some liquidity. I have this building in an undesirable place, but there's no way I'm going to sell it. The reason why people don't want to sell is you got it, taxes. You don't want to pay the taxes. So the problem is that if I have $1 million building and let's say it's depreciated down to nothing, and I have $1 million gain. If you take a look at the tax code today, you're paying a 20% capital gains rate. You got the healthcare bill with another 3.8 plus 10% state. You're looking at a very large tax. Let's say maybe almost 40%, 35%, something like that is going to going to the IRS. So $350,000. You got to cut that check and give it to the IRS. Most people say, you know what? No, I don't want to do that. I'm going to hold on. Here's something that you can do. You can transfer this into what we call a tax-exempt trust. Tax-exempt trust. So you put the $1 million building in the trust. The trust sells the building. There is no tax, 0% tax on that sale of property. The trust sells it. It's a tax-exempt entity. Then you could create income from this $1 million. So would you rather build income on 650, 700,000, depending on how much tax that you're paying, or $1 million? Well, of course $1 million, because you can produce more income. So now you're producing a lot more income. You avoided the capital gains tax. Here's the caveat though. At you and your spouse's death, okay, right here, about 10% of the remaining balance needs to go to a qualifying charity. 10% of the remaining balance needs to go to a qualifying charity. So let me ask you this question. Would you rather pay 10% or 35%? The answer is a no-brainer. Of course, most people would want to pay 10%. Here's the deal. If you give a gift, the IRS will forgive the tax. It's a pretty cool strategy. Of course, there's so many different caveats. I'm talking very high level, but a lot of people don't understand these strategies, and there's a lot of things that you can potentially do to create larger income, sell the property, avoid the capital gains tax, and then here's the kicker. With this $1 million transfer, you also get a tax deduction. Because 10% of the remaining balance is going to go to charity, you get a $100,000 tax deduction today. 100 grand tax deduction today. Now, that will offset higher incomes. You can do different things like Roth conversions. There's a lot of different unique planning that you can combine these things. It's a little bit more advanced, but we're talking end of year tax planning. There's still things that you can do. You can set this up before year end and get a huge tax deduction.
Yeah, Joe, one of the best things about this strategies is you can increase your income pretty substantially, because when you have real estate, you may only be receiving 3-4% cash on cash. When you set up one of these tax-exempt trusts, you may have 10, 11, 12% rate in terms of a distribution, because you're getting income and principal back to you. So you can dramatically increase your income, save on taxes, give to charity when you pass, get a tax deduction today. I'll tell you what, even if you're not charitably inclined, this is a great way to sell your appreciated real estate.
Right. As we said before, everyone is charitably inclined. It's just depending on who you want to give to. Do you want to give to the IRS, or would you rather utilize your capital to the best of your ability, and then at the end maybe give to a qualifying charity, something that you really have passion about? If you don't have anything passionate about, well, find something to get passionate about, because you're going to save a boatload of tax. Hey, we're going to take a quick break. When we get back, I want to get into a couple more strategies that you want to make sure that you utilize before year end. We got your email questions that Big Al wants to talk about. I also want to get into what is called a gift annuity. A gift annuity. So it's like, well, what the heck is that? I don't want to go into a commercial annuity. No, this is something completely different. Some people get confused on the term annuity. It just means income, and you can get a lot of income by doing this strategy, so don't go anywhere. Show's called Your Money, and it's Your Wealth. Hey, welcome back to the program. Show's called Your Money, Your Wealth. Oh, sorry. So I don't know if you saw the label on the cup, but yeah, Pure Financial. Sorry, that's shameless.
That was shameless.
Let's
that
get
was terrible. Hey, wait a minute. I'm still thinking about something you said last segment.
Let's get to the true-false question.
All right, here we go. If I give a donation to charity greater than my income, I will forfeit that excess charitable contribution forever.
That's a great question.
It is a great question.
Because if I'm, in that last example, if you guys just joined us before the break, we're talking about some more or less advanced estate planning type tools and charitable giving type tools. And then you can create very large deductions, $100,000, $200,000. But wait a minute, if I only have $50,000, $100,000 of income, maybe I'm retired, I don't have a lot of fixed income, and I have this huge charitable deduction, is it all for nothing?
Yeah, and here's really how it works, is you're limited normally to 50% of your income as a deduction. So what that means then is if you make $100,000, you can give away $50,000 and have it be deductible. Now, when you give appreciated stock, then you only get to do 30% of your income, so that's $30,000. So if you have extra, in Joe's example where you had a $100,000 deduction, what happens is it carries over to next year, and you get 5 years to deduct it. You go through that same limitation, 50% or 30% of your income, and you deduct what you can, and then it carries forward the following year. So when you're planning your charities, when you have big deductions like a tax-exempt trust, make sure that you can deduct it within the time allowed.
A lot of good things there. And so I can take the deduction that year, and then it will continue to carry over. It won't carry for life, but it will carry over for at least 5 years, so you won't lose that deduction potentially. So a lot of good things there. Hey, you know, I was talking to Debbie Rossi, Big Al and I. She was in our office. She's the Director of Plan Giving for the Salvation Army. And so she was talking about a tool called a gift annuity. Big Al, I know that your family, actually your father, has used this tool before to create income, to get a tax deduction. So when you're looking at a couple of different tools and items to either create income and get a tax deduction at the same time, maybe a gift annuity might be something that you might want to look at.
Yeah, this is a pretty good one, Joe. So my dad's done this through the National Park Service Foundation. You can do it through a lot of different organizations. But here's what it is. You actually give money to this organization, and what they do is they give you back an income stream for life. And that the interest rate that you're getting on this income stream, it's just a little bit lower than you might get with a commercial annuity. So there is a charitable donation part. So in other words, you're getting a charitable deduction today, and you're getting a payment stream for life. So this is a case where, you know what, I feel good, I'm giving to an organization that I want to give to, but as long as I'm living, I'm going to receive a payment stream, or as long as my spouse is living, I'm going to receive a payment stream, and I get a tax deduction right now. So it really is a great thing to consider, particularly if you're talking about maybe $5,000, $10,000, $20,000, whatever it may be. When you're talking about the tax-exempt trust, like we talked about last segment, that would be probably for bigger assets.
Yeah, I mean, so there's a lot of different things. I think right away when people think about giving to charity, it's like, okay, well, the money's gone. But not necessarily. There's different tools that you can use that you can still provide yourself an income, get a tax deduction, and then also then at the end of life give a nice gift to a qualifying charity. So it's not, all right, well, here I'm just going to cut a check and give it to the charity, which is good, right? You get the tax deduction and everything's fine, but there's still things that it's a win-win. It's a win for you, and it's also a win for a charity. Hey, let's go to a quick email question.
All right, this is from Anthony in Huntington Beach. I have about $500,000 in my trust account and $500,000 in my IRA. If I give half to charity, if I want to give half to charity and half to my nieces and nephews, does it matter which assets I leave to charity versus my nieces and nephews?
So I guess and let me clarify the question here. So he's got money in a retirement account and he's got money outside of a retirement account.
Right.
And then so he's wondering, all right, well, which assets should I give to the charity? Which assets should I give to the kids?
Right, that's exactly, or does it even matter?
Yeah, so it definitely matters because, sure, right, you want to give your retirement accounts to the charity because you can avoid the ordinary income tax versus the kids would get a step up in basis if they inherited you know, your trust account or assets outside of a retirement account. But I guess, Al, it depends on what his basis is as well inside, you know, the stocks that is outside of his retirement account.
Well, exactly right. And I think that's exactly what you want to do. If you're going to give to charity anyway, do it through your IRA because the charity, when they get the IRA, they don't have to pay the tax on it. Now, if your nieces and nephews get it, they have to pay taxes on it. On the other hand, if you're giving assets that are not part of your IRA, they're going to get what's called a step up in basis, as Joe just said. So maybe you bought a stock at this level and now it's worth this amount, right? All that gain goes away when you pass away. The kids get it at a new cost basis, they sell it, they pay no tax. So really that's the better asset to give to your nieces and nephews.
Well, 'tis the season to give. We talked about a lot of different strategies when it comes to figuring out, all right, well, can I create a tax deduction? Can I do good for me, but also do good for a qualifying charity? There's a lot of things that you can do. Hopefully you found this informative. And now it's time for you to take action. You have, what, a month left before the end of the year, December 31st. 99% of all tax planning needs to get done before year end. So get off the couch, start organizing things, and get things done. Thank you so much for joining us. Next week, we got another great show lined up. For Big Al Clopine, my name's Joe Anderson. You just watched Your Money, and it's your wealth. Have a great weekend, everyone.